Hello and welcome to another episode of Macro Mondays. I'm James Todd, stepping in for James Brody, who's away this week.
I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
And I'm Ed Hayden-Briffett. I'm a research analyst at Onyx Capital Group.
So today, as always, we'll be looking at key market data, charts and risk. We'll be looking at some of the big headlines over the past week, especially focusing on the trade deals between the US and the EU. In precious metals, we've seen some consolidation, and we'll be looking at headlines as we have a busy week ahead of good data coming out. So to start us off, the major headline of the week was announced over the weekend, which was this US-EU trade deal that was announced on Sunday. So we've seen some reneging of Trump's heavy rhetoric regarding tariffs, and it's going to be having a serious impact in markets, isn't it?
Definitely. I mean, I think it was a bit uncertain as to whether they'd actually come to an agreement. There was a lot of pretty chaotic discourse in the lead up to the agreement on over the weekend. I think the key factor here is going to be on the energy side. So the EU has now agreed to buy $750 billion of US energy over the next sort of 3 years. And that will they'll completely open the market 0% tariffs and invest $600 billion in the US. This is a pretty huge deal. I mean, that something like 2/3 of global trade is between these two partners. It's massive.
Yeah, it is worth remembering as well that this is the framework for the deal. This isn't the finished article. And there was the French, I think the French finance minister or the PM, I can't remember which, came out and said that like the weeks and months of negotiations to come. So this is just the first step. It's also, the EU is still going to have to pay, importers of EU goods into the US will still have to pay 15% tariffs on their imports. So it's not it's not a free trade agreement at all. But it is a better outcome than it could have been for the US.
Considerably better for the auto manufacturers as well, who were subject to a 25% tariff. Now it will not be additional, it will just be instead, it'll be 15%.
And, these commitments are pretty huge from the EU. And yes, it's not sort of, as you say, the finished article, but in terms of the framework that was initially provided for how the tariffs are going to be looked at, it was essentially done on a balance of trade. And with these huge commitments to $600 billion of investment, $750 billion of energy purchases, etc., it's very simple to see that from a US trade balance perspective, this is going to be beneficial in that isolated sort of framework. I guess the question becomes, is this going to be good for the US overall? And 15% tariffs are still quite sizable. But
I mean, it's marginal, as in every additional increment of tariff will lead to some level of demand destruction, because that just means higher prices for the consumer. But relative to where we were kind of even a week or two ago, I think this is only constructive for the global demand outlook.
And in terms of, if we now look at sort of equities in the US, and particularly you've mentioned in the car manufacturing sector, we've seen a pretty interesting move there, haven't we?
Yeah, well, the Stoxx 600 auto index is up today to its highest since I think mid-May. And I think that's part of what we'll refer to quickly is that the car imports are now subject to this 15% tariff. And crucially, within the EU's comment, it said that there will be no stacking. So 15% is the ceiling. They won't have to pay 15% plus the additional 25% auto tariff that Trump has imposed globally. So that is really why you're seeing the car makers like Volkswagen, BMW, all the kind of the big German, particularly car makers, why they've benefited in the stock market this morning.
It's it's an interesting area in particular, though, obviously car manufacturing, because yes, the history of the US with it, I think it's often widely cited that Detroit General Motors used to be absolutely huge, and now as a city, Detroit has been struggling since car manufacturing has closed down there, etc. But in terms of the actual manufacturing of cars, so many of the component parts that go into cars are subject to tariffs as well. If the US car manufacturer was subject to a 15% tariff on, windows that were being imported, the glass being imported from Italy, for instance. That's pretty significant to them. So these are always going to be the finer details that have to be hashed out. But
and I think that is really kind of the weak point in Trump's trade policy. We saw that with rare earths from China. So China basically stopped exporting any rare earths at all, and they account for about 80% of the world's rare earth production. Heavily used in magnets, and with the new wave of EVs, that's obviously critical. Any sort of industrial process will probably involve some sort of motor or something, and that will require these rare earths. And I think, like you touched upon, that is the area that Trump wants to target. Really, that kind of Rust Belt America that's felt struggled a lot, really, in recent decades, just because of free trade and lack of comparative advantage.
Yeah, if you were to think about sort of in your mind's eye the core Trump voter, that demographic, I think, is certainly going to be impacted by these changes. And then in terms of sort of outward confidence in Trump's economy, how has the market reacted there?
Well, I think it's still very much wait and see. I think there's an element of a bit of paralysis. I don't think the market really wants to think too far ahead right now, because there's been a lot of whiplash, and as we can see, the 2s10s haven't really it's not moved lower. It's still pretty steep. We've come off a little bit, but still within that stubborn range.
It's a move down from a higher peak, isn't it?
But it's still very much within that range, sat on that support. I think there's few things that will push it lower. Perhaps if the market starts to price lower Fed cuts at the front. I think the disinterest in the back of the curve from most of the investors will kind of keep a lid on how much lower the 2s10s can go, and that obviously comes from a fiscal sustainability perspective. And we've seen that investors withdrew $3.9 billion from Treasuries, and they've been going into corporate bonds instead. So in Europe and the US as well, actually. So we're seeing corporate spreads compress, and I think that's kind of a repricing of this risk. You're seeing the trade-off between a treasury and an investment grade corporate start to fall, and so you're going to take that high yielding investment grade corporate.
I think as well, this chart gives you quite a nice indication of the Trump approach. It's the art of the deal, right? You come out with some huge position like he did on Liberation Day, something, and then the market reacts very rapidly. You can see that big spike at the beginning of April. And then it kind of consolidates as he like winds back a bit, moves towards a more negotiated position. And I think the same is true for Powell and the Fed, because he's come out to say like he's rubbish, he doesn't know what he's doing, lower rates, he could be fired, could be removed, whatever. Now he's saying maybe he won't be fired, but he is still having a go at him over the cost of the Fed renovations. So he's giving a bit of ground there, I think, and the market has calmed down slightly on that front as well.
Yeah, and I mean on that point in particular, obviously, if Trump wanted to fire Powell, there's very little in his power that he could do to push for that. But there was a lot of people calling for Powell's resignation, etc. But even if Powell were to step down, the monetary policy is decided by a committee. It's a vote by a committee, and that committee on the whole is still relatively hawkish. And there's a couple of members, Waller in particular, who's perhaps on the more dovish side. But changing the chairman at the Fed, I think, would do very little for the future path of interest rates. And I don't think Trump's going to get anywhere close to the 3% cut he's after by getting rid of Powell.
And then looking on a sort of wider scale, because obviously it wasn't just the EU that had this sort of headline trade deal announcement. We also saw Japan with their trade deal that was yet again, done right before this, what was it, 1st of August deadline? Or,
it's this Friday. Even.
This Friday.
It's going up pretty fast.
There we go. So, everything's been done right at the last chance saloon. But we've seen, obviously, $550 billion promised from Japan to invest in US companies, which, it's the similar sort of story to the trade balances with EU. So what are we making of this?
Well, I think there's still a lot to be unpacked. I think it's still in negotiation.
Yeah.
No one really quite knows what that $550 billion package is going to entail. Of course, I mean that if this goes through and we do end up with a more beneficial trade agreement between Japan and the US, then that leaves the door a little bit more open for hikes at the central bank.
And with these trade deals as well, I think that the US is going in with a kind of a misapprehension in terms of if these tariffs are removed, everyone will suddenly rush to buy our products. So rice particularly has been Trump's big bone to pick with the Japanese. Like they don't buy enough of our rice, they grow their own or they import it from other Asian countries. I'm not convinced that just lowering the tariff on US rice imports is going to suddenly see the US selling loads and loads of rice to the Japanese, because it comes down to consumer choice at the end of the day, and it's not just about the price, it's also about the product. And if the Japanese rice is superior, they'll continue buying Japanese rice. It's a sense of hubris, really, from the Americans.
No, absolutely. And if you think about sort of the nature of a tariff as well, it's always ployed as a percentage. So if you were to say, a kilo of US rice was $1.50 more expensive once you've factored everything in, less infrastructure in development and also cost of shipping over. So if you were to have $1.50 per kilo of additional price per kilo of rice versus what is already quite a low fixed amount, that's a huge percentage that you're already trying to attack. So you have to make these tariffs on specific, whether it be agricultural products, whether it be energies, etc. As a percentage term, they're absolutely vast. They have to be in order to affect sort of price competitiveness at all.
Yeah.
So
and I also wonder, how much of this is Trump trying to achieve a win? It's getting close to deadlines and then having to delay deadlines. It doesn't paint a particularly good image of Trump's negotiations.
Well, we're seeing the same with China now, aren't we?
Exactly. And I think in a way it's just he's trying to get something through the door and trying to get a win. He came in promising a lot when he came into office and has delivered on a relatively small amount of that. So even if it's not necessarily making perfect economic sense, not that any of it did start with, but I think it's more of him trying to get a win.
Yeah, I agree on that. Yeah.
And moving on to China, we've seen PMIs coming out in China this last week, and it's been not necessarily as positive as people would want. Who are going to be the losers, and are there going to be any winners out of this data?
Yeah, it's one of those. I think in China, bad news in some ways, good news, because it just means the PBOC and the CCP are going to come and throw whatever they can at the economy. And we've seen tax breaks being upped this year. I think it was huge. It was about 7 trillion over the past 4 years worth of tax breaks. 7 trillion yuan, that is. So this is, and here we have 600 billion coming in the second half. So that's going to really kind of target the consumer, but also target the industrial side of things. And interestingly, I think on the industrial profits, it was largely driven by falls in profits by state-owned corporates. Now, state-owned corporates, of course, they can be loss leading as long as they wish, because the CCP can issue at 1.7%
on the 10-year.
So they can just issue at that, and that they'll be okay. Private sector corporates did slow growth. We saw growth slow, but it's still growing. A big hit was coal. Coal industry.
I think it was down by 50% or something.
It was like 58% down. Oil and gas extraction was about 11% down. So that's not massively reassuring, but I wouldn't say that there's anything necessarily to worry about. If anything, this will just motivate more stimulus and be constructive in the next sort of 6 to 8 months.
I think the only thing China has to worry about is that the stimulus, we've been saying, is going to translate into improved domestic demand. The problem that they're having now is that as yet it's being really, really slow to do so. I think they're going to be concerned that whether it actually will produce enough demand stimulation that they're hoping for in the longer term.
I think the interesting thing with stimulus is that in the aggregate, you're right, pass-through has been quite slow. But if you look at certain sectors that have been really targeted by that stimulus, say auto consumption, so EVs in particular, Chinese households get a huge rebate on any EV purchase, and the consumer trading programs that target specifically durable goods, they've seen a rapid uptake, and that's going to be positive. But you're right, it's.
I think one thing worth noting as well in terms of how you define stimulus. In the West, it's typically, if you were to look at stimulus, you're thinking sort of QE and similar things like that, basically. Exactly, an increase in the monetary supply. Whereas what you've seen in China is a lot of actual changing of the fabric of loans and credit conditions, etc. And that's not done overall and blanket, but it's done very targeted. Yeah. So on EVs, the nature of the loans that people were able to get, it was basically like no deposit and no guarantee of repayment, but we want EV demand to rally. So you've got that sort of infant industry protection. And so if they go sort of industry by industry and target the loans for that, even if these make the sort of the notional value in dollar terms or yuan terms lower because they're deliberately suppressing the price in order to increase demand. Yeah. So even if these industries, the top line rate may not be rallying, but it's that sort of development of infant industry, which the goal is in the long run, you're going to create these behemoths of companies.
It's always strategy.
Yeah.
The CCP have a very long-term view on almost everything they do.
Exactly.
I think that's spot on.
And if you're sort of looking at perhaps PMIs being a sort of more damning indictment of the state of economy, China, we saw negative headlines, and we're saying, okay, maybe that's not so bad. But in Europe, we're seeing these PMIs looking not so good, and we're probably fearing the worst.
Yeah, I think in Europe, it almost feels a little bit more concerning because they seem to have less cards in their hands. We've got a mixed set of PMIs from Germany and France, especially on the manufacturing side. The Euro area aggregate marginally outperformed expectations, but still remained contractionary at 49.8. So it's tough to say. I think there's been a rebound in optimism that came in with the Germany fiscal package, but then actually on the ground, I think the picture still looks pretty concerning from a demand perspective.
Yeah, and we still got this divergence really in the services versus manufacturing aspect of the economy, because you got manufacturing, particularly in the old big economies of Europe, the Germany and France, is really struggling. And then the services have been outperforming consistently for the last year or even more maybe. Yeah. And it's also the smaller economies like the Spanish economy, that's been the one bright star really. Italy's been beginning to struggle more as well. So I think maybe they are beginning to run out of steam in these smaller economies that have been trying to prop up the ailing older, bigger economies.
I think on the services side, it's a lot to do with hospitality and tourism. So that's what Spain have done really well since COVID opened up to tourism massively, much to the frustration of the domestic population.
Yeah, the locals are not happy
the
about it.
inhabitants of Barcelona,
but that's going to be supportive of service sector industry. And I think on the manufacturing side, it's the same story, with Germany struggling to achieve any sort of comparative advantage against China. Even with Chinese tariffs, it's difficult to compete.
And in the UK, yet again, things probably aren't going to be that fantastic as you look at headline data. So we saw retail sales expanding month on month versus June, but this was not as much as people were expecting.
No, so it was expanding at 0.9% month on month, but markets expected 1.2% growth. And it's also coming off a previous drop. So, you always have to consider this data, particularly monthly, in context of the previous month's print. And yeah, it's not a great sign that the UK and UK consumers feeling particularly optimistic. And you've seen that the cable, the pound to dollar, has been a bit volatile last week or so. It's been 134 to 136 going up and down. And I think that there is generally a kind of sense of pessimism around the UK economy. Just the overall coverage of economics and business themes in the UK at the moment is pretty dour.
Yep. And then Ray Dalio had some thoughts this week.
Yeah. So he thinks the UK is stuck in a debt doom loop. He's pretty pessimistic on the debt outlook, kind of globally, I think. And it's true. I mean, the UK does have an inherent overspending problem, and the Labour government tried to kind of tackle that with some reforms to the PIP and to the welfare state, effectively, and that didn't materialise. There was some rather outspoken backbenchers that tried to block that and were successful in doing so. So I think it really is a spending problem. We've seen the increase in capital gains tax over the past, so they reduced the threshold from about £12,000 to £6,000, and then they reduced it again to £3,000. And both of those concurrent years, we've seen 10% falls in capital gains tax revenues, and that's the nature of it. It's the Laffer curve. If you increase taxes beyond a certain threshold, you're going to see capital just flow out.
Yep.
And that's exactly what's happening. The spending is the issue, not the tax.
Yeah, and in Dalio's opinion, we should be putting it in gold, but that's been a bit sideways lately.
Yeah.
The next tab.
I mean, we'll go on to discuss gold, but it's a bit of an interesting chart because we came close to testing that upper bound again. We've seen basically a quadruple top near the all-time high levels, and of course that initial spike came around Independence Day. A lot of sovereign uncertainty in the US, etc. Gold seen as a classic alternative store of wealth. Good if you aren't confident in the greenback, etc., or equities. But we've seen we're stuck in quite a boring range here.
Yeah, so it almost mirrors the 2s 10s actually, which is quite an interesting correlation. But I think a lot of this is to do with the blowout of ratios, so against other precious metals, and we're starting to see them catch up now again. I think also we've seen a lot of strategic purchases of other commodities by central banks and governments. So in China, famously, that's been oil recently.
Yeah,
they've been buying a lot of oil. With gold at all-time highs, does it make sense to be buying for strategic reserves, or should you maybe hold off a little bit and let other asset classes catch up? In the case of China, they will just buy constantly.
Lower levels, pick it off.
Exactly.
And then I guess for the sort of institutional traders, there's nothing screaming, this is a time to buy, nor is it screaming, this is a time to sell. You are just stuck within a range. Yeah. And unless you have some sort of differing opinions, if you were to take a view on this, you're probably taking it on the back of other asset classes, sort of not being as nice a opportunity for you. So it's not buying gold for gold's sake here.
Exactly. Yeah.
But and if we look at the sort of some of these alternatives, I mean, we spoke about silver previously, but platinum and palladium, they're sort of showing indications of consolidation. And
well, we mentioned it last week as well, didn't we? Look, like Will said, you look at the other metals and it's kind of a ratio thing. So we had this big rally in platinum and palladium, and then it seems to have come to a bit of a top and is beginning to move sideways, consolidate. And I think the question is how long that will go, if they'll then continue the rally or if they'll taper off as people move towards more risky assets again. Like as the trade deals do come out, there's less concern about demand destruction. And I think that will really depend upon the trade policy that Trump's pursuing.
Yeah, I think also, yet again, as we mentioned last week, quite often if you're more on the retail side and you're looking for alternative investments, it's, you can go and outright purchase sort of like gold equivs or whatever, but you can also go and look at baskets of precious metals. So if that precious metal has a basket, whether it be an ETF equiv or whatever, if that's got palladium and platinum, etc., that's going to be supporting that. So these things I think are going to be very correlated over the next few months.
For sure.
And then speaking about sort of gold and the gold standard of crypto, we saw some groundbreaking research done by Citi.
I mean, the headline that Bitcoin will go up if more people buy it, and it will go down if they don't. It's like, pretty economics 101. But that is the point, really, isn't it? If more people were worried about dollar depreciation, inflation, Bitcoin is kind of an obvious alternative to the traditional gold. And that's why we've seen it reach 120K. And again, like gold, it's been pretty consolidating over the last week or two after it jumped to that time high.
But, I think to an extent, this is almost all of the fundamental analysis you can do on Bitcoin. I think it's really hard to value. You see a lot of stuff online, people drawing the Fibonacci retracement levels up to 200K, and it's like, is it going to get there? Who knows? It could do, it might not do.
It's a gamble, basically.
It's an interesting one because there are two, to sort of dig into what cities say here. Okay, like if more people buy Bitcoin, its reach in terms of population increases, that's going to be supportive. But one of the things that does provide upward pressure as well is the select few people that have profited historically from Bitcoin and other cryptos. If they take money out of alternative cryptos and pump it into Bitcoin, that's still a really significant upward demand. So, I think what they're trying to say here is perhaps that upward support is going to be capped to some degree, and it's going to be quite dependent upon wider outreach. And I'm not sure that you're seeing as much hype around Bitcoin and leading to FOMO as perhaps you maybe even did a year ago or 2 years ago. So just to sort of round up here as well, let's take a look at the OIS pricing for the next 12 months. So what are we seeing here?
So we've got 86 bips priced by the Fed of cuts. We've got 20.4 bips priced by the ECB. We've got the Bank of England pricing 70.2 bips of cuts. New Zealand at 48.1.
And then RBA is minus 67.6, and then CAD is Canada is 14.4 by the end of the year rather than in 12 months. And still, Bank of Japan is the only one looking to hike.
Positive,
and it has come up slightly from last week. So
and
we'll see where that goes.
I think that's partly being priced by the yields, as we've seen them start to rally a bit more. Interesting to see, especially the data this week.
Yeah, so we've got quite a lot of data coming out this week. Starting on Monday, we've got India, their industrial production, and we've got Fed manufacturing data coming out of Dallas. But then, from Tuesday onwards, we start to see a bit more coming into the equation.
Yeah, so on Tuesday, we've got Spain's GDP. We've got the ECB consumer inflation expectations, US house prices, JOLTS, the Conference Board consumer confidence as well.
And then, Wednesday is a GDP day, it seems. It's US GDP, European GDP, plus then you got the first of a whole slew of US employment data, which is the ADP measure. And then Thursday is kind of inflation day. If Wednesday is GDP day, Thursday is the inflation day. We've got US PCE, all sorts of European inflation, Bank of Japan's decision on interest rates, and then finally the China NBS manufacturing PMI. And on Friday, there's the NFPs, which is the culmination of this kind of 3-day bonanza of US employment data. The Caixin manufacturing PMI for China, Spain and Italy are catching up with the HGOB PMIs that we got last week. We referenced about Euro PMIs earlier. Euro area inflation, and then finally ISM manufacturing PMI as well.
Yeah, so good amount of data there. I mean, obviously non-farm payrolls are going to be, seeing some reaction, but US GDP headline data, obviously a retrospective figure, but will be, interesting to look at. If you want to keep up to date with any and all of this news, we will be providing daily updates on LinkedIn as always. So look up Onyx Institute there, and otherwise, let's regather our thoughts and keep an eye on the headlines coming up this week. Thank you very much, and we will be speaking next Monday. Cheers.
Thank you.